And we're up to week 3 now, so it's not too hard. I mean, we're moving at a good pace. Your grades were good so far, so I'm pleased with that. Let's take a look. This is something I don't want to share. Here we go. So let's look at the IP. That's the first thing I want to do. So if we look at the IP, I'm going to go into announcements, and I'm going to go to week 3 IP guidance. Okay, so let's do that first. So really what you want to do is you're looking at the, and then we are recording, but my friend Mike is here. Okay, so macroeconomic factors. So we're going to talk about different factors that impact the currency. So macroeconomic factors might be things like short-term interest rates, right? Because remember, when you have a currency, one currency as opposed to another, right? If you have one currency as opposed to another, the US versus the euro, what you want to remember is like when you buy a stock and get a dividend, when you hold a currency, you can earn interest on that currency, right? That's almost like a dividend, right? One of the reasons I'm a big believer in gold, but one of the reasons why people don't want to buy gold is because it doesn't earn anything, right? So in low interest rates environments, gold is more valuable than currencies. However, currencies do pay interest. So if I bought euros, and I'm not doing anything with them right now, but I just want to be in the euro, because I could take the euro and buy European assets. I can buy buildings or I can buy stocks. Same way people buy dollars and they can buy buildings and stocks, but or anything they want to buy in the US as an investable asset. But there's also, what if they did nothing with the money? Well, if they did nothing with the money, well then the return on that money would be the interest rate that you can get in the bank, the risk-free interest rate. The risk-free interest rate here is considered the 10-year treasury bill, which is about 4%. But over there would be there would be the euro, whatever the 10-year euro pays, which is probably around the same. But remember, so if one country is paying a higher interest rate than another country, it's going to attract more capital because now you can earn some more money on your currency. And at least as a base, even if you bought an investable asset, you have to earn at least a risk-free rate. So most investable assets will trade at prices that are above the risk-free rate. But the risk-free rate's important. However, you also have to think about the rate of inflation. Because if I'm earning 4% in either the euro or the dollar, and the US is running at a 2% inflation rate, then that means my purchasing power loses 2% a year, right? Because prices are going up. I mean, we see the price of eggs, but it's also got to be, we're not just living on eggs, we're living on everything. So let's say our inflation rate is 2%, then my real rate of return is going to be 2%. The 4% I earn from the government, less the 2% inflation rate. Now that same 4% in the euro, if you get an inflation of 3% because of the Ukraine war and things like that, because remember the Ukraine produced a lot of goods there, so things became more expensive. Now your rate of return there is only 1%. So therefore, on an after inflation basis, you'd rather be in the dollar. Okay. But that's just one factor, right? Also, trade balances mean a lot because anytime anytime a country is exporting a lot, they're going to want to keep their currency lower. And that you have to factor in too. Because the fact is, the European markets sell the US a lot. The US is a consumer-based economy. And they're going to want to keep their currencies low relative to the dollar. Because if their currency is lower and the dollar buys more, people buy more goods from them. Think of it like when you buy a car. They'll say 0% financing. Now we all know financing is about 7% now. So why would they give you financing for zero? Because they're making money on the good. They're making money on the car. Well, it's the same thing. The European governments don't mind if their currency is a little weaker because they're making money on the goods that they sell us. So those are things you want to address in this. And in the long-term effects, people buy currencies because they see great growth in an economy. They see less debt by the government, which causes inflation. Because right, if the government is running higher debt totals and they have to print more money to keep their debt and to pay off their debt, they're essentially putting more money in the economy. And if they put more money in the economy with less goods, you got inflation again. So you want to keep an eye on how stable the government is in terms of using debt and their economic stability. Okay. So these are some of the main macroeconomic factors you're going to want to consider when you're talking about the week 3 IP, and show that you understand where values come in, right? Now, in terms of socio-political factors, well, we see what's going on in the Middle East and in the Ukraine, and these are political events. And in the Middle East, you got a lot of civil unrest because of the issues that are happening there. And that's going to make people a little more reticent in terms of getting into that currency, because they're going to worry, well, I don't know that I don't know how stable my currency is going to be. So those two issues are definitely going to be something that we're going to be concerned about, right? And then afterwards, you got the long-term effects, which are things like government stability. If the governments are stable, well, then they're going to attract more investors, because you're going to feel that the countries are going to run into political issues. They're not going to run into wars. They're not going to run into any kind of unrest. You see some of the countries in South America, like Venezuela, have had huge problems with inflation. Well, that's a lot of it is other countries aren't willing to support them. They worry about the leadership, right? And purchasing power parity is something we've talked about for a while. It's how much does your dollar or your currency buy versus another currency. So if your currency buys more of the goods that you need every day, well, then effectively your purchasing power parity is strong. And as you earn those resources, which is the currency, you're going to be able to buy more and more of the goods that you need. Now, one way we kind of measure PPP is with the Big Mac index, because we know they sell the same item called the Big Mac everywhere in many places in the world, and we try to see how much it takes, how much resources do you need to buy that Big Mac, and that's a way we can compare purchasing power parity. You know, how much does one currency cost against another? The flaws of that thinking is if I'm eating a burger in Vietnam, it's going to be a little different than me eating the Big Mac in Madison Avenue. So we can't really compare apples to apples. One thing I like to look at on a more micro basis is I recently did a video and I posted it on staying at a Four Seasons hotel, which is a top of the line hotel in Manhattan as opposed to Montreal. Now, obviously, Manhattan and Montreal are two different places, but Montreal is a beautiful place. I mean, you got a Parisian feel, you got good food, it's a pretty place depending on the weather, and New York is, they have basically the same type of weather patterns, not exact. So, of course, New York is New York, but at the Four Seasons in Manhattan is going to run you probably anywhere between 1,200 and 1,500 a night, whereas a Four Seasons hotel in Montreal is going to probably cost you 500 or 600, half the price. So you could argue, all things being equal, ceteris paribus, that in that respect, you got more purchasing power parity in Canada because it buys more. All right. But again, these are not exact sciences, because one person might say, well, New York is New York. But that's all a function of, again, 50% more. Interest rate parity, we talked about the difference in interest rates and trade weighted expenses. So that's the exchange rates. That's the country's currency value adjusted for the relative value of a trading partner's currency, which we talked about. We know that some countries are going to want to keep their currency low because they make money on the goods. Then there are speculative factors like investor confidence or market speculation. And these things are going to definitely be a factor in terms of what moves the currency. Like think about economics 101, where part of what determines demand is people's expectations. It's not just price all the time, because we know the lower demand, high prices, low demand, low prices, high demand. You also have to consider the fact that people have expectations. And if they think goods are going to become more desirable or something's going to become more valuable, they're going to buy that thing. And it's the same thing with a currency. If somebody sees that a currency has more value or perceives that the country is doing better, or it's going to be a desirable place to invest, well, then that currency might do better. And investors also will have confidence in buying that currency. Finally, we could look at the long-term effects, which is the trust that you see in a currency. You're trusting that the policies, the central bank policies, remember, what does the Fed do? The Fed creates situations where they try to give their dollar integrity, because it is the reserve currency of the world. So what the Fed is trying to do at all points in time is make sure that the dollar has purchasing power parity. So one of the reasons why right now we're suffering with higher prices and slow housing growth and things like that, it's actually a function of the Fed wanting to slow down the economy, because if they could slow down the economy, they slow down the rate of inflation, because inflation will diminish what the dollar is worth. So how does central bank acts? Global perceptions, um, things like that, that's going to affect the currency as opposed to another. A lot of factors here, but a lot of them are concentric, which means they kind of overlap with one another. And then again, give me some textbook references, give me some examples, and we should be okay with this particular project, okay? All right. The other thing is on the guidance, you want to remember that what's the impact of uh, MNC, or revenue and profitability. If a company earns revenue in a foreign currency, that weakens against the home currency, right? So you have to think about costs, hedging costs, investment decisions when you're looking at doing business in one country as opposed to another. Let's get back to currency. So if I'm Coca-Cola and I'm doing business in a foreign country, say the euro, and I'm earning money in the euro, well, first of all, I could pay my operating costs and I could pay those costs in the euro. So that kind of balances out. But then I got my net profits, which have to come back to the US. Well, if the euro weakens against the dollar, then it's worth less money in dollars. And effectively, I could be making money on my operations, but losing money on my currency. Now, that could be mitigated by hedging. But whenever I hedge anything, of course, I lower my risk downside, but I lower my profitability on the upside. And it also has to be disclosed to my investors. That also has to be disclosed to my investors, because you can't just hedge your currency without at least letting your investors, your shareholders know you're doing that. Because when they see that Coca-Cola is doing really well, but they're losing money, they're going to ask questions, and that's rightly so. And their questions are going to center around, you know, where do we lose money? And it's going to be on the currency. Now you can hedge the currency once again based on using hedging. But remember, whenever I hedge a currency, which means I would, if I have to take those euros and send them to dollars, I would sell euros and purchase dollars in a currency contract to lock it in. But if it went my way, if effectively the euro got stronger and stronger, I would be losing money on that contract. So I wouldn't make the maximum amount, but I wouldn't lose the amount on the downside. But my argument to my shareholders would be, well, I wasn't in the business of currencies. I'm in the business of selling sugar water or Coca-Cola. Some investors might say, great, that's what we want. Some investors might say we can hedge on their own. Because remember, that's a fundamental principle. They could just go out, they know what their income looks like, and they can put their own hedges on if they're a big enough investor. So like even when you buy a stock that doesn't pay a dividend, that doesn't mean you don't buy the stock if you demand a dividend. You just buy less stock and put some money into cash and like in government securities, and you create your own dividend. Here, investors, if they want to, can create their own hedges. And nowadays with ETFs and stuff like that, I'm sure, I haven't looked, but I'm sure there are ETFs on low dividend stocks where they enhance the dividend, and they may in fact do that for you. You know, it's something I got to look up. So that's how you're going to do the discussion side. Again, we're going to talk about things like volatility in the stock, access to capital. And the most important thing is you want to know if if your country, especially nowadays, has any kind of regulation risk. How does taxation look? What does regulatory compliance look like? And you're going to use an overseas multinational investment bank that's going to work with you, the MNC. So you're going to use like JP Morgan or Credit Suisse or Swiss Bank or Santander, or any of the big Morgan Stanley, and they're going to kind of guide you through regulatory risk. You can use their attorneys, or you're going to get your own attorneys if you're big enough. And you got to watch if there are any tariffs or trade restrictions. All these things that kind of come into play if you are a multinational, which you want to be in friendly countries that want to do business with you. Okay. So, you know, that's really basically it on this.